So people like all the first time founders in their first couple of rounds, they undervalue their equity heavily. And then they realize that, oh my God, like what's in it for me? The answer was equity, right? And then you want to protect it. And then you want to do things around so that you protect your own wealth also and your team's wealth, right?
Both of you all have been very active angel investor. It looked at from both sides, right? Some founders feel like, no, I want to just focus on this, maybe till you build it out. For others, like it's great to get operators along the journey so that you all are supporting. And if you all can share the economics behind it, like angel investment has become a big thing over the last 2 years. But we all know that
suddenly has crashed as well.
And
I find it extremely funny.
I was going to say
And I find it extremely funny. Anybody who tells me nowadays I'm not investing, I'm like, dude, tu tab kab tha?
कब शुरू कब किया?
Tu kabhi
तू कब आया कब गया? तू आया गलत
तू
टाइम
हाई टाइड में exactly
और जा भी गलत टाइम पे जा रहा है.
तू 30 मिलियन वाले राउंड में एंजल इन्वेस्ट कर रहा था $5,000. अभी तो 2 मिलियन में 10,000 नहीं कर पा रहा है.
But do you think seed rounds have at least corrected in India?
Yeah.
30 has become 15, right? But 15 is still fucking not a great entry
But I think it's okay. I think it's okay because my view is TAM is increasing, adoption is increasing. Output.
I hear this in India, but even at a US scale, and I like in last 12 months I've done a few in US, and I'll tell more about that also. US with good founders, even like top tier VCs, right? Pre-seed rounds, not the seed ones. Pre-seeds are still happening at 5, 7 and whatnot.
Yeah.
Right?
No,
so then if
थोड़ा सा
yes, and it's not correcting. I think that's become the norm now, which is, I find and that's when the economics become a challenge, right? Because then at some point it's very difficult, very rare.
No, I think in India also, I tell you, I see two different ends of the spectrum. One is these social signal founders, right? For example, I'm not talking about second time founders, right? I'm talking about, for example, ex-Zoho, ex-Freshworks, ex-something, right? Where the signal says, or ex-VC. So signal says, oh, no, you know what? This guy is going to raise the next round. Now, this is the poorest way to look at it. But unfortunately, I have also seen that it worked for a lot of people. Doesn't work for me. On the other end of it, I see people in the name of correction struggling for a $2 million cap round.
Yeah.
Which is, so it's not like that there is gas in India and it's not correcting, right? The problem is that either there is a signal or people are calling it a signal, or there is absolutely lack of signal. In lack of signal, correction is brutal. And I don't even call it correction. I think it's also like a deep, unfair end.
Yeah, correct.
I see people diluting almost 20% for 300K.
And those people...
Which just kills me because I'm like, dude.
Next wala nahi hoga.
Yeah, so any investor who's actually... So I basically made a startup correct their valuation from 3 million to 6 million. Only because I actually reasoned it with an angel investor who was really, enthused. I was like, dude, you know what? You're basically killing them. And your outcome is going to diminish just because you are killing them in the process. Don't do that. It doesn't make sense. Either you are rooting for a $500 million or a $400 million or a $100 million outcome. In that case, 3 and 6 million will not matter to your life. Or you're rooting for their failure, in which case you should not invest any which way, right? Yeah. It's a binary, it's a high risk problem, but you don't hedge risk by killing the man who is actually supposed to build it out, right? You leave some stuff on table for them to do, right? Yeah. I actually believe that as an angel investor, if you cannot think about the founder more than any other traditional or a professional investor, I would say. Yeah. See, somebody who is having a corpus of money taken from somebody else with a promise to return a certain multiple has to think about money differently.
Correct.
Angel investor, the definition of angel investor is that you are not supposed to think about that money that ruthlessly. You don't want philanthropy. You're not throwing money away, but you also can take risk. Taking risk on your money versus taking risk on somebody else's money are two different problems.
A counter view to that also is that a lot of angel investors are very, very much flexible on the valuations, which ultimately, in short term benefits the, ecosystem. And YC is actually a great example, not an angel investor, right? But YC has kind of just, bloated the valuation to a great extent. And ultimately, like the founders start feeling that that's my base valuation, that's my entry point. The biggest downside of thinking that, my pre-seed valuation being 15 or having a pre-seed valuation of 15 is that you end up assuming my company is actually worth $15 million at that point.
But that's
and then you start benchmarking your growth after that. So when you say, when I had 100K revenue, I was 15 mil. When I have $1 million revenue, why am I not at 100 million valuation?
But I differ there on only one aspect that, honestly speaking, if anybody wants to value any company from a multiple perspective at 100K revenue, then I'm generally like, dude, you know what? I don't think you understand the company stage.
There won't be multiple. I fully agree.
Yeah, there's no multiple, right? Because a 100K company can be valued at 10 million and you'll not call it a 100x multiple. It doesn't make sense.
Then even more interesting question. How do you put the right value?
Let's
say if the founder never came to any valuation,
fair point.
And if you had to value the company, how would you do it?
Fair point. My recommendation, and I think that's why YC valuations got bloated. There's always a downside to too much freedom and democracy. My belief is that if a founder asks me that, hey, how much do you think my valuation should be? I will say, hey, you know what? Go 2 years out in time and basis your own projection of what your revenue or what your product or what your PMF cycle is going to be. What do you think 2 years from now you want to command or you feel you will be able to command, let's say in a Series A. Okay. And let's work backwards from there. So that, because we are not trying to bite as much money or save as much percentage today. We are just trying to say we should not be bloated for that day. You can still be wrong. But if you're thinking about it, you won't be like wrong by a mile. You'll be wrong by a few inches, and that is okay. That haircut is bearable.
Even that is very tricky, in my opinion. This is, again, they're all,
I don't think
they're agreeing and disagreeing both together.
I think there is no right answer to that. I agree with that. Right? I'm just saying that problem is not that. For example, any founder so right now I'm doing, I was talking about to somebody who's raising at 25 million pre-product. But guy has very strong signals, right? All check boxes are there, right? So much so that one of the angel investors who was, really passionately asking him, dude, please give me $50,000 allocation. This guy was saying, no, I don't have allocation. And I was just watching this. I asked that guy, the prospective investor, that why are you so passionately asking for allocation? Like, you understand that it's a 25 million pre, right? It's not a cakewalk.
Yeah.
He said, you know what? I can bet on my life. If nothing works, this guy will sell it for 50 million. You understand the gas on gas and on gas, right? This guy feels that the signal is so strong that a pre-product founder can actually exit for a 50 million outcome just because he has come from the right company, he has come from the right background. Founder himself has had a $20 million exit, cash, so he does not need money in life technically. And he knows all the right people to spin this story and probably create an exit. Now will you call it wrong? I don't think so.
Did you participate in this company?
I can tell you, but I'll have to kill you.
No, did you? I know the company now.
That's not the point. The point I'm making is, my point is that, do you think it's wrong? I don't think so. Do you think that the investor who's trying to get in is wrong? No. Do you think this founder is wrong at raising, trying to raise at 25? I don't think so. Because I know that his problem statement is not whether it's bloated or not. His problem statement is, can he raise the next round at a valuation which is at least 2.5x of this? If that remains true, he can kill at a 50 million seed round as well. And I think somebody did a seed round. So Vijay Raipati of Atomic Work, right? Now, right, he basically raised 11 million, seed. People are making a lot of hoopla about it. Some people, right?
Yeah.
I personally don't feel it's wrong or right. I simply feel like basics. One, the guy knows how to build product, has a background, did a successful exit, worked very well in the acquiry company, knows what he's doing, has gathered a stellar team. VCs are ready to put money.
Yeah.
Can he get screwed if he is not able to raise his next round, 3x of this valuation? Yes. But is he wrong in commanding that valuation right now? I don't think so.
Yeah.
The guy has every social signal aligned with him to think for $1 billion outcome. Whether he can do it or not is a separate story.
In fact, I met him last week, like someone from his team. They had more money on the table. He didn't want to raise as much, but they had more money available.
Correct.
Even at the
And that can be counterproductive as well, by the way. So Dhruvil is right.
Yes.
It's not that he can't fall into a ditch, right?
Correct.
I am just saying that there is no right answer to that.
Yeah.
I think the right answer is the founder's ability to traverse the path ahead. So when I talk to seed founders who don't have a lot of money, being thrown at them, and when they are trying to figure out what's that, a D2C founder recently, for some weird reason, they basically said, okay, our valuation is going to be 40 crore. And they did a revenue of 5 crore last year.
Okay.
But it's a D2C. Margins are, differently placed. It's not a SaaS. It's a brick and mortar play. I asked him, I said, why don't you raise that 20 crore? He said, oh, no, that'll be too low. I said, no, I don't want, I'm okay with 40 crore. It's a question.
Yeah.
So, and somehow, whatever transpired, I actually made him realize that I don't know what the right number is. You need to figure out the right number.
Yeah.
My only question to you is, I don't want you to be miserable 18 to 24 months from now. So you take a view of 18 to 24 months, bloat it a little because you're optimistic, but don't get ahead of yourself and get screwed 2 years from now. They finally raised at 25 crore. And trust me, that was also his decision. He literally called me a month after. He said, we are raising at 25. I said, see, I was okay with 40. I'm okay with 25. I'm okay with lower. You do whatever you want. You have been warned. Because I don't want you to be miserable. I think I find that also okay. Because I now know that if he hits 15 crore plus in revenue 2 years from now, which he will. He has a path. He has a linear path to that. I can see that path. For him to raise at, let's say, 50 crore, it's not going to be a problem. People will be there to back him up. And so far that happens.
And so what I also feel on the economic side is that, eventually, I think most of the founders are not really chasing liquid wealth as of now. A lot of, especially the first-time founders, their job is not to really create liquidity for them, right? They are very excited. They want to create innovation. They want to create impact. They want to build a great team, and they have all the right intents. They want to add customer value as well, which is great, right? But they haven't really thought about how will I make money? What's in it for me in terms of cash? And I think that's what and that's why they're okay. They are also okay as long as they successfully raise the next round at a 2.53x, because that's their valuation of success, right? They did it in their journey. Now they also probably, even if they don't make it into cash, they will again leave and do the next thing. And probably at that time, they will know how to get cash. So eventually all these guys will, kind of first-time entrepreneurs will reach liquid wealth. But then on the way, you're kind of basically, kind of stepping onto other people's, money while you are trying to make your own money.
Probably the best segue to the entire series is called the Founders Playbook. And nothing better than this, because this is one of the questions that all founders have, right? Like, honestly, it's just like how in the product world, finding PMF is a myth. I think finding that early valuation is not as easy.
And it's also very difficult, right? I remember this is all the stories I'm able to say in hindsight.
Correct.
I remember when we raised our Series A, right? And this was 2016, so not as bad as 2021, but it was a wave.
Okay.
It was very easy to raise money. We practically did not have any meaningful revenue. We had revenue, but it was not very enterprise, meaningful, global revenue. It was not SaaS. It was all mixed up. Didn't know what we are going to build for future. At that time, we had one acquisition offer from one of the largest, e-commerce companies at that time. Another minority offer from another competing e-commerce company. Looking at that, there's a traditional player also jumped in and saying that, if these guys are doing this, probably this is the way to, command your authority on the market. So they also made an offer. And I'm like, this is very actually easy, right? You can just play people against each other and, you can just kind of get out of it. We ultimately closed on a very good terms, very good valuation, pretty much no revenue, and only 12 months of mistake. Borderline depression. Right? A lot of people leave you. We fortunately did not have layoffs because people just left us, half of them. So we did not have to lay off people.
Because of the market, right? Market then shifted.
Market also shifted, right? And this is usually happens after this wave. There will be some correction. So it's not that we couldn't raise more money. We still had good 60% of the money in the bank. But the 40% was wasted, literally wasted, with zero outcome whatsoever. With people who are unhappy because they entered at a higher valuation and then their stocks have no meaning, right? And all that was done was storytelling. And when you go through all these things and you come out of the after 12-month journey with 40% low, money gone, which is 40% of your equity gone, right? Or your dilution gone, and you don't know what you're gonna do next, right? You feel very sad as a founder, and that's when the true founder journey begins. Right. That's when you actually become an entrepreneur. I think that's when at least I became an entrepreneur.
I've seen that, it's very interesting. I've seen that cycle literally with every entrepreneur around me, the most seasoned ones as well, that whenever they got like a new shot of large capital, they went through this cycle of wasting 40% of it.
Yeah, I think it's
each time.
very common.
Each time.
It's a very common mistake.
Yeah. I mean, somebody who has run, recently I was talking to a friend who has run a company for 18 years, seasoned, sharp, smart guy, built a revenue of, 100, 120 crore, reset the journey, built a much higher revenue now, got a shot of, couple 100 million last year or 2 years back. And he was recently telling me, dude, last 2 years we blew up so much money. Now we are correcting. I was like, when does this stop? He said, I don't know what happens, but somehow, the judgment gets clouded, and there is probably no other way, right? And I personally feel that there is a lot of this pent up energy, right? Because when you're growing, you start feeling suffocated in your cocoon. Right? You're like, you know what? I can probably rock the world. Something is stopping me, right? And the lowest thing the minimum thing that you can think about is money.
Yeah.
And money means resources. That means a lot of people, a lot of geographical bandwidth, or I don't know what. And suddenly somebody throws money at you, and then you are like, all right, now I'm going to do everything that I, thought was right.
This is so good. I think this is a great way, great point to mention that this is actually not a founder thing. And we all, I think in our ecosystem, we keep talking it's founder thing.
Right.
It's a human psychology.
Yeah,
so yesterday,
pent-up energy.
Yeah, this is classic example. Yesterday, somebody was in a presentation was sharing that like what really happened in 2021 and blah, blah, blah. It's also like big tech executive.
Got it.
Right? This is an executive of one of the largest tech companies in the world, right?
Mm-hmm.
And the question was asked that, while founders do this, even big companies did the same thing, right? Like you had crazy excitement from investors because of the tech being the next big thing when pandemic came, right? Like NASDAQ, every stock of NASDAQ and the shareholder thought, we are like the brick and mortar world has ended now.
Right.
And it's all going to be tech everywhere of any form or shape. And that's why any tech company listed were getting crazy, kind of valuations. And then you, of course, a lot of them raised more public money as well at that time. A lot of them went IPO at a very premium, right? So they attracted that cash. That cash basically went into hiring more people. These people who wanted to work remote were half productive, but still were able to make double the money because they were making great commissions because everybody was fucking even buying tech, right? So on SaaS, even their customers were on a cash pile.
Correct.
They were buying a lot.
Correct.
People sitting at home and individual consumers were getting free money from the government, right? So it's easy money accessible to everybody in an easy environment, right? And then when that kind of suddenly goes away and the reality check comes, then you kind of realize that, oh, this is all gone, right? And then you talk the exact same thing that we're talking in hindsight, but in a big corporation context versus the startup context.
Well, I'm very curious. You both have been operating, your companies for close to a decade now. And say you get a fresh round of funding now, do you think you'd still go through that 40%? Like, is there a learning here that new founders now can take up from this? Like, what is like you mentioned, maybe it's human psychology, but second time around, do you think you'll make the same?
At least I can speak for myself, and I think most of the people that I know who have gone through these cycles and who have kind of gotten the shock once, like they've gotten a shot of adrenaline once, and then also got a shock after that.
Right.
I think that they would do it because I think then you see how I think now is that, and we have like to an extent that we don't even feel like announcing anymore, right? Because we know that it's not really, it doesn't do anything whatsoever to you, right? It's just your personal satisfaction that you were announcing it for. And beyond the time, like even the people you attract are also those who would actually focus on, like cash flows, business. Like in today's, like our current, workforce at LogiNext, we would have half the people who wouldn't even know about what's happening in this world of AI.
Got it.
Right? They're working in a high-tech firm. We do a lot of stuff on AI.
Right.
But they don't really know that AI is just rocking the world and, so much is happening because they don't care about this. They are not, affected and they don't have any FOMO. They're still talking to their customers, they're building products, and that's their kick in life.
Got it.
So I think eventually I don't think that really affects the second time once, or at least people in their journey would raise in their like later years. And also I think there's another thought that where you start to becoming more for the lack of better words, equity hungry, right? So people like all the first time founders in their first couple of rounds, they undervalue their equity heavily, and then they realize that, oh my god, like what's in it for me? The answer was equity, right? And then you want to protect it, and then you want to do things around so that you protect your own wealth also and your team's wealth, right? You see, like we have seen cycles where people would join for, as I said, right, like for higher stock options value, and then the value would actually reduce, so they don't get anything out of it. We have also seen people who actually came at a very early valuation. The value went very, very high, did not know how to exercise, when to exercise, ended up paying heavy amount of tax. Right. So when you realize that, okay, this is like real people's life and careers are getting affected by your decisions that you take, then you do it in a different way. What's your experience?
I think, I don't know, if I had to raise, if I get like a large round of funding, or if I had to raise one, the way I think today is that I will definitely have this, this pent up energy, problem for sure. And just by thesis, 40-50% of this money is gonna go in inorganic experiments because you don't know what you don't know. But will we actually go crazy, bloat things up? No, I don't think. I think we have been disciplined too long to worry about that part. So we will not go crazy. For sure, I don't even worry about that. But yes, I think I can, at a smaller level, I can think that, as the prosperity of our company, because we are a bootstrap, cash flow positive, profitable, these are the way of life for us. It's not a strategy.
What is the real reason you didn't raise venture and went behind more of a bootstrap journey?
I think the real reason I would say is that, so from early on, when we started the company, we did not believe that we needed cash. Right, so we were very organically saying, okay, we're building, customers are paying, we were getting a lot of high from that. Then, within under 3 years, I think 2.5 years into the journey, we one day got exposed to a VC at a party, and that VC really came very, strongly, and he said, what you guys are doing is great, and I'm coming to your office next week. And he actually came to the office next week. We got a term sheet in next 48 hours. And we were like, yo, wow. And we didn't have a deck. We didn't have a projection. This guy was just, and this is 2014. This is also not like SaaS was sexy. This is like e-commerce is sexy.
SaaS was not even a word.
What were valuations back then? Like,
this guy offered us $1 million at 3 pre-money, 4 post money. We replied back saying 5 million pre for 1 million. He said okay. Then
and were you doing revenue at that point of time?
Our revenue must be shy of 150K annual.
Fair enough.
Right, so less than 1 crore for sure. And this guy said, and then after a week he said, okay, I'm going to give you 3 million at 6 pre-money. And we're like, okay. And then started the dance of that, okay, we have an IC and we were still discovering these terms. And he said, okay, what's your CAC and what's your LTV? And we had no fucking idea. And we almost told him that, you know what, we don't do PPTs and we don't have a 5-year projection. We live quarter to quarter. If I want to stretch my imagination, I can give you a 1-year plan. But I will not give you a 5-year plan no matter what. So they send their one of the associate to our office. That this associate from the VC fund is going to draw up projections and PPT for us to present to their IC. So I was like, "Aapas mein kar lo na." So, but this is a very, very cool learning curve, right? Because when they started asking us questions and they started, pulling the model, I could see that they were basically trying to create a model to blow up $3 million as promised in 18 to 22 months with no sign of revenue. In fact, there was a day after like 2 or 3 weeks when I called this VC partner and I asked him, I said, but I saw the projection sheet. I can clearly see that we are going to hire a VP of engineering and a VP of sale and a VP of 20 other things. I'm not able to understand where will the revenue come from because the revenue column is still 0. He said, oh, yeah. Pricing is friction. we'll make your product free. I was like, oh my fucking God. So I said, but when will we make, how will we make revenue? He said, we'll figure it out at scale.
Okay.
So like, okay. And this was the first point where me and Sakshi said, wait. This is something like, this is going definitely right or wrong, I don't know, but we were definitely not comfortable. Long story short, after a month, this offer got revised to 7 million
Okay.
at 35%. So whatever that valuation might be coming out
Sure.
to, right?
So basically, you were going to be raising $7 million.
Correct,
Okay.
correct. They were revising it, right?
Which at that time,
Which-
Right.
a lot
Which
of
at that time was a lot of money.
Huge.
And you have to understand that we were still confused about 1 million, what to do with it.
Exactly.
Right? We were honestly confused about that, okay, what will we do with 1 million? In our head, 1 million was more like that you will put it in FD and you will run the company
From
with
the
a
interest.
burn which is equal to interest. This was my view of life. Okay? So 7 million was like... so there was a point after a month, we basically finally lost it because we were told that we will open offices in 11 countries and it was literally a world domination plan with $7 million in 22 months. So I did a DD on this VC
Okay.
and I started speaking to their founders.
Okay.
And I found two types. One were the founders of this VC fund who basically were not doing what this guy was saying, who were technically doing what we were doing, as in, first principles. And the other who also were the guys who worked with this partner who got screwed by some of the principles that he was telling us. There were few successes as well from the same principles, but I don't know. They were being copy-pasted. This was our early experience. We finally, one day, me and Sakshi went, said no to him. This guy was pissed.
Was this how venture used to work back in 2014? Was this
it
usual?
still works like
No.
this to an extent.
No. This is how it works.
Fair enough.
So,
This
And
is
we'll
top
talk
tier,
more about it also.
Yeah.
this top tier
Okay,
fund. This top tier fund.
top tier India.
This top tier fund India, right?
Okay.
So we finally said no to him. And this guy was of course pissed, but we couldn't care less because our point was that for you, we are a portfolio. For us, this is life for now. And we don't know anything else. So we would want to conserve this. Even if we go slow, we are okay with that because we are building it for our own fun as well.
Yeah.
I want to live the journey nicely as well, right? Whatever grind I go through and shit I go through is the shit that I need to create. You don't create that shit for me because I don't know how to deal with your shit. I barely am trying to deal with mine,
Yeah.
right? So I don't want yours.
Yeah.
The other VC fund approached me the very next day. Almost felt like, some coordination. And they said, you know what, you should become Zomato. Said, but we are a B2B restaurant tech. So no, you should become Zomato because, money is in B2C only. There is no money in B2B. And they legit said, what is SaaS? What is B2B?
I heard the same thing in 2016.
There is no money to be made in B2B. This is 2014. So I said, thank you very much. We are not saying no to possibility of becoming a Zomato later. If we have 100,000 restaurants in India, we can always, create a layer of B2C on top of it. But maybe day after tomorrow. Huh?
When we get there.
If you want us, you invest today. You invest in this B2B, and we are going to remain B2B for next at least 3 years that I can foresee. So they also went. The third one came exactly in succession, and they said, no, these guys are fools. You should not become B2C. I said, okay. You should remain B2B. I said, okay. But you should become Shadowfax or Roadrunner.
Logistics.
We're like, what the fuck?
Because that was the season of logistics.
Correct.
Hyperlocal.
Right. So Hyperlocal was getting up, right? And this was this VC's unresolved deal issue. They could not get into
100%.
Roadrunner or something, right? So they basically wanted to resolve by inventing this with us. I think this exploration scarred us a little because we did not think that VCs were wrong or right. We just felt that they don't for sure understand what we are doing.
Okay.
And whether they're right or wrong is not for me to decide today. What is there to decide for me is that this money's mandate is not matching my mandate. And if it is not matching my mandate, even if this marriage happens, there's going to be a disastrous one. So we took a step away, like not turning back ever again types. Over years, we kept on talking to VCs because they kept reaching out. We, in the ecosystem, we kept on, meeting, having a lot of candid chats. I think there came a point in 2017-18 where it again dawned on us that maybe we are suffocating the opportunity. Maybe we need to raise and, just go full on. And I had another round of discussions, thankfully not pitching because my morale would have been crushed. Because again, what I heard, now was the season of SaaS and B2B. But now the season was, who goes enterprise? You should build from India, sell to the world
PLG.
at a cost arbitrage. See what Freshworks is doing. See what Zoho is doing. And my point was that with due respect to what these guys are doing, my business is not that. My business is something else. And I need to tailor it to not only what I want, but also what fits in this. So that again became this one was a quicker one. Like within a week, we were like, okay, nahi ho payega. These guys are not, India does not understand enterprise, and I don't blame them as well. India has not seen enterprise software succeed from India the way we will be. And the fact that we now have a Freshworks, in next couple of years, we will have a LogiNext, probably a Posist or somebody else who will prove that enterprise software from India can reach a certain threshold and become a global player. Probably that will create a different wave. We don't have a winner right now, so I empathize with VCs as well. But the fact that they are not there yet, even in 2023, by the way, a lot of VCs, I can tell you, who till today have been talking and tweeting about enterprise tech and whatnot, in person, I have had conversations with exactly those people.
Okay.
And their understanding and understanding of the gestation period they need to have, or they need to give the startup to really prove the enterprise hypothesis for real is very, very shallow. They still are fiddling, with, mid-market is also great, it is bloated. They're still hunting TAM. My problem is that if you're doing enterprise, you don't need to hunt TAM. You need 200 customers to hit $100 million revenue.
Yeah.
Right? But point is that you probably need a longer gestation period. You need to bake the product right. You need to bake the relationships right. You need to create credibility. There is a brand building. You are going against an Oracle or a Cisco or a Microsoft or a Salesforce. You don't do that overnight. Execs who are supposed to buy your product, either in US or India or in Middle East, anywhere for that matter, there is no playbook. Playbook is trust, credibility. A multi-billion-dollar revenue company's exec's job is on the line. They're not going to trust you. It doesn't matter whether you are a X-VC or a Y-VC funded, how many $1 million. Nobody cares. You have to talk to them, put yourself on their radar, introduce yourself, keep showing up long enough, keep them, updated with what you're doing, keep nurturing, keep building case studies, keep moving, keep the ball rolling. And then one day, they will actually slice out a small part and say, hey, come here. I'm going to take a bet on you. And you need to wish that probably you will land and expand. You see Nutanix. I had a chat with Dheeraj last year. I was doing a fireside chat with him. I actually asked him that, how does $1 billion revenue pie look like? What he told me blew my mind on one side, but at the other side, it looked absolutely logical. He said, in $1 billion, 5 clients contributed 500. There are 5 clients which contribute $100 million each. And then the smallest client was doing $1 million. I said, how do you land a $100 million client? He said, you don't. You land them at a 500K, and then you expand over 10 years to 100 million. And that was the point. Land and expand. Manoj was telling me that these guys landed Walmart at $100,000. Walmart is contributing $300 million revenue to them right now.
I'm not sure I've said this before. So currently one of our number one client by revenue is McD. Okay. They do about $2 million ARR with us, right, across multiple countries. We started with them in Malaysia at $20,000 ARR.
See?
It is, and this is like a 3.5 year story, right?
Okay, this is something I would love to go deeper on. But before that, I'd just love to get your perspective on the venture side of things.
I think I'll just summarize by also adding one more thing that, I think venture capital is a very difficult job, I feel, because they are put in that position by the world and by themselves and by their LPs, where they have to be those visionaries to take the right bets and understand the hell out of a business model without actually doing it. Yeah. Right? And it's a very tough thing. Try gauging something in extreme depth and taking a huge bet on it without actually doing it. True. It's very difficult. It's practically impossible. Yeah. And that's why there are good VCs and bad VCs. Right? There are good investors and bad investors. Just like there are good entrepreneurs and bad entrepreneurs, right? And the good ones are very few, on both sides, right? Yeah. And that's why I think, like generally, more often than not, you end up with those other, investors who are not that much in depth. They have not worked as hard as good investors have. And that's why they end up building a worldview very quickly by having a few conversations. And again, those few are not 10 or 20. Those few also are in tens or hundreds. But good investors go deep into these tens and hundreds or even more before they really build their thesis. And that's when, and those are the ones who actually know about this sales cycles, ACVs. They know when to start calculating CAC and when not to think about CAC, because when it's not possible to think about CAC and probably it's not worth thinking about CAC.
Absolutely. If a VC talks to me and asks me how much is your sales cycle, and if I say 9 to 18 months, if he replies, oh, that's long, they fall off the cliff for me right there. Right? For me, the right answer to this question is, yeah, makes sense. That's all.
The sales cycle question was the toughest one I was consistently asked in my 2015-16 raise from every VC whatsoever. And to an extent, I used to call it B2B software because they ultimately used to translate SaaS into B2B software. So then I realized that I should not be saying SaaS. Maybe if I say B2B software, it will click to them faster. And I would say B2B software, B2B business has a collection problem, long sales cycles. And then I think in 2019, I started pitching in the US with of course, not that US is a very fancy territory, but of course, these guys have seen more number of businesses in front of them, scaling up in a B2B format. And sales cycle was just never a problem.
Yeah.
And I was finally so relieved that, oh my God.
The right answer is that this makes sense, right? Because if I am telling you that I am gunning for $500,000 to $1 million annual accounts, and if I also tell you that I close in 3 months, I am a scammer, you should run away.
And their question was around, and they would immediately look at the revenue book and they would look at the smaller accounts and they would say, if these guys are large companies and still small despite being there with you for 1 year, there's something wrong. And that's the right question to ask.
Correct.
Right? Not that why did you not close them at 200K or why did they not give you 200K on day one, like on 30th day itself, right? Or why are your sales guys, when they join, why they can't close the deal in 60th day itself, right? What are they doing for those 2 months, right? And why not why are they wasting 6 months and whatnot? So I think they look at the same data, but ask much more relevant questions. And I think that's because they've seen those businesses operate and cycles operate.
My one add to this, conclusive add is that people who think or say, I hear this a lot, money has no color. Wherever there's money, just pick it up. Whoever is giving you money, take it. People who think money has no color are colorblind. Money has color, and you need to definitely match it with your color of the day, of the year, or of that time. Otherwise, you'll look like a fucking clown, and it'll be disastrous. A VC does a lot of diligence on the founders. Founders need to also do a diligence on VCs, not to figure out whether they're right or wrong, good and bad. To figure out, do they match their color or not, right? Some of the worst VCs are also good with certain founders. Some of the worst founders are good with certain VCs. Because it's a match problem. We should be playing the same game, right?
And that's also a job and the differentiator of a good founder, which is very few, right? And I've also, in my first couple of fundraisers, which we could never understand what this color of money is. Never asked the question. With lack of experience, you end up doing that. And that's when I think whenever even seasoned founders or second-time founders or founders with signaling, if they are also not evaluating investors, VCs, then there's something wrong.
In your opinion, for a first-time founder, what matters more? Is it the fund or the partner that they're going to be associated?
100% the partner, I would say. 100%, because partner is the one who's going to do the journey with you, not the fund. Fund is only going to be a brand, which I don't know what will you do with. But if you can leverage that brand, it has its own soft benefits. If you can leverage that too. But partner is actually the one who is going to journey with you, who will have conviction or lack of it on you, who is going to be your wall, for all the arrows that are going to come your way, and who is the one where you need to find the most alignment with. Because misalignment is where the boards, really become crazy.
I'll give you an example of this.
It's not really good partners, bad partners, right? It's just misalignment.
Wherever you guys both were yesterday, right? That fund is a classic example of how amazing the fund name can be and how different partners can be so different within the same fund. And that definitely,
if you were to
I think my view will be that run a diligence by speaking to their portfolio.
If you can go deeper, especially for first-time founder, assume someone at the other end of the spectrum that you mentioned in the beginning. for you, y'all are really well connected now. But think of, your journey 10 years ago, where you don't probably have that founder network. Like, is it really go the hustle, figure out the...
I think the easiest, a quick one, and then I'll let him give a longer one. But I think the easiest one that you should do with to find other founders is to actually send some cold reach outs, nice ones. You do not sound like you are doing some diligence or toxic diligence or negative diligence, on anyone, because ultimately that party is probably going to be more loyal to the fund, right?
Correct.
But in a positive way.
Small world, they will hear about.
So you should definitely let the fund know that is it fine if I reach out to a few founders, right? That's number one. And I'm pretty sure nobody will say no. It's very difficult for them to say no, or most likely they would say no. What I'll connect you with two of them, and you can also just it just takes a little bit of a more of a gutsy conversation, which I've seen in US a lot, and India doesn't somehow happen. But you can also politely ask that don't worry about it. You let me do two. But I would love to talk to a couple of two separately myself also. And that's exactly what investors do with customers as well, right? It's not that you give two customer references and they only talk to them. They will do their good ones, they will do their market research. Similarly, do your market research, send cold emails. And most often than not, founders are super helpful to jump on a quick call and share their views. Like, they would not bluff. The response rate would be surprisingly higher. I think that's the easiest one you can do. Another thing you can also do is to ask about, questions about their top portfolio journey or their worst portfolio journey without naming the company. Asking about, what are the different revenue stages they went through. I ask about IRR also, to be honest, right? Because I want to understand that what is your expectation at the end, because I've had investors who exited also with certain returns on LogiNext, and some of them were very, very happy, and some of them at the same returns were okay about it, right? So even their percentage returns also vary. So I think that's a great question, but I think that's again, once the founder has a good understanding of IRR, him or herself, then it's much easier to ask that question versus not.
I think I'll just plus one to that, and I will recommend one more thing, which is not only look at not only reach out to the founders of their existing portfolio, the ones that are thriving and the names that the VC is taking. Of course, those are the ones who are doing well, right? So the relationship is doing great because things are going well. Dig out, defunct companies. Dig out companies that shut down, or the founders that are no more with that fund, and they will actually tell you what didn't work. For example, in my diligence, I'll tell you, this VC partner was telling me two things which were really unsettling. One was that we are going to take you global from day one. We were not ready from the product perspective. We knew that we will go global someday, but we were not ready. We also knew that. Second, he said we are going to make the product free and figure out the business model later once the transactions go up. Right? I actually dug out by chance a company which was basically going down from their portfolio of this partner. And I got to know about that company, from someone, bottom out, right? And I met the founder. And guess what he told me? I said, this is a great business. You guys were doing well. What's happening? He said, well, we scaled outside India too early. And then we made the product free. Today we have 80,000 installations all across Southeast Asia and India. But we are not able to find the business model. So these guys are not doing the next round. I was like, ouch, right? So what I figured is that I also found another founder who took both these advices and was very happy. And was the portfolio which was like the stalwart, right? Well, my point is that this did not paint a picture saying, okay, this partner is good or bad. But this did make me realize one thing, that this partner has a playbook which he believes has worked for him. And he's tipcoing that playbook everywhere. And just by probability, somebody succeeds and somebody gets drowned. But the fact that somebody got drowned on his strategy, he did not pull him up. He did not do the next round. And I'm not asking him to do that, but I'm not going to be that guy. So one is that look at the failed founders or the companies that are not doing so well, for sure. And second, on the IRR part, right? It's a funny one, but it's important one. I generally also ask them that what's your the fund that you are investing from? In what year this fund is going right now? Right? Because generally funds have a cycle. So let's say 7-year cycle, right? So if you get money from that fund in year 1, you're quite chill, right? These guys are not going to crush you until year 4. I mean, they may want you to grow, right? But it's not going to be soul crushing. But if you are getting money from this fund in year 3, trust me, you have 18 months.
Yeah.
You better raise your next round because markup needs to happen in this one for sure. Can you control that? I don't know.
No.
Should you know that? 120%.
Okay.
And see, there's also now more and more dynamics are getting added, and we can go hours on this one.
Yeah.
But now there are hedge funds, right, which are semi-liquid for their LPs, right? That their LPs have a call option like every year, right? So then they will give you a very weird answer that we don't have a fund cycle.
Sure.
We don't have a fund life. We have this, and then you're like, oh my god, this sounds now you can't argue much, right? Because you didn't know about what that means.
Correct.
Then there are greenfield
But there are
funds, right? Like which have no
first
time.
time founders will not.
None of these used to do early stage investments. Now all these guys are doing early stage investments. So that's when now it was not like it was.
But I think one thing that I will say is that when you have a very, very large fund, like the one Dhruvil mentioned, these kinds, if you are a first time founder and if you are taking very small money from a very large fund, you're setting yourself up for failure in a very, very big way. Because when you take money from a top tier large $5 billion or $10 billion fund, and if you take $1 million from them, see, the problem is that they don't really care about $1 million. I have actually seen a large fund, a very large fund who gives you very small money. They're not going to kill you by intrusion because too small a money for intrusion.
Correct.
They will kill you by indifference.
Which is they will not probably participate.
If they don't participate in, if they don't participate in the next round and you go out in the market, everyone is going to ask you two questions. One, are they participating? Let's say you say, yeah, they will do pro rata. They'll be like, why are they not leading? You will have no answer. Two, the fact that you're out in the market, if you are such a great opportunity, why are they allowing you to be out there in the market? You are supposed to be the one which they protect from both hands. So that's another one lure that I hear a lot at times where some partner is telling a founder, small company early, saying, oh, you take $1 million from me, I will do that without IC. And I generally tell them, no, don't take money without IC. If this guy can put money without going to investment committee, he can also write off this money without going to investment committee. Please ask him, give me money that requires IC. I want everybody's buy-in, right, on the fund. Very hard decision to take, but very important.
We have a similar process that we had figured in 2018 in enterprise sales, right? We're just changing topic a little bit, where we used to acquire some of the large customers, but we thought 20-50K is an enterprise ACV.
Right.
So we were acquiring them and we were very happy that now 50K enterprise customer, big brand name. The company is large, right? But giving us 50K, which for them is peanuts. For me, it is enterprise in my definition. And we would acquire them, and a lot of times we would churn them after like 3 months, or even they would not even be engaging enough. Like they would not have integration budgets assigned. And we were like, of course, you have to integrate. You can't use enterprise software to automate your workflow independently. Of course, you have data and legacy systems in place, right? You need to connect. And they would say, we don't even have one single developer. We have no SI to do it. Now you do it for us, right? And we're like, why should we do it for them, right? And some of the other examples also, we realized, and then sometimes the invoice would go to their accounting team, who had no fucking idea how to process it, who approved it. Like there's no signature. Then they would say, oh, PO number dalo, this, that, all of it. Right? This is also not just an India thing. This is a US global thing also. Then we realized that one of the biggest problems is that we don't have finance and legal team only or procurement teams involved while procurement. And that's why what happens is that our sales cycles become shorter, right? And we still get that good 50K entry point. But it's not a sustainable, and there's no expansion happening after that. And probably we're not being taken seriously.
Got it.
Then we started making sure now, since last 4 years, we have procurement/finance/legal.
That's a part of...
as a must-have initial. That's like a qualification criteria. It's not an SQL. It is going to be an MQL without that. Like marketing can say this is interested party, can buy. But salesperson cannot say this will close even this month or after 3 months if some of this is not involved. And huge benefit. And I also now, because there's so much of data privacy clauses, indemnification, insurance, liability clauses, there's just enterprise contracts are heavy with a hell lot of stuff, which protects them and protects you also from the fuck-ups that you may have done, right? And that kind of, and that naturally creates larger entry ACVs also, because now they have done a thorough evaluation of you and they are themselves feeling more confident in you, right? While you yourself may not be as confident.
Important has sponsored, right? So you have to have a sponsor internally who's like, this is legit stuff for them, right? I think one analogy I can give you is, why marriages are done in public, right? Marriages that are announced, that are done in public,
I understand.
Right? That's the point, right? So basically, if a VC is telling you that, you know
The
what,
stickiness
if you
is
take
higher
if you
after
take only $1 million from me or $500,000 from me, we don't need to go to IC. It's like somebody telling you we'll do secret marriage, right? Secret marriage. Secret marriage will also evaporate secretly.
Right, fair enough, fair enough.
So you need your marriage to have like a 7-day celebration. Both the parties should invite all the family. You should get scrutinized by each other, each other's family. There has to be a lock-in. There has to be an announcement. There has to be a celebration. There has to be an announcement, right? It should go through its own scrutinizing grind, maybe criticism. It's okay. Going is not going to get tough. It's just going to get solid. And it's very, very important. I have the same principle for VCs. I have the same principle for customers. Secret marriages don't work.
Nice.
Across the board, this is a very important one.
One part I wanted to cover was you touched upon it, but it's a great playbook on storytelling, selling, and building relationships. These are 3 things we talked about. So if you want to go deeper on that bit.
On the US side or on the global enterprise sales side, see why we always, like when we compare with the local people doing a better job at selling, I think a lot of that part is also because it's natural to them from a cultural point of view, right? Now what that means. America as an or Western culture has largely been around discipline and brand, right? Which are the 2 things that probably a lot of Asian countries, lag. And then we, as an upbringing, we're not taught or told the importance of that.
Yeah.
So you need to kind of practice that really hard, and that's why I think spending time in the US locally or anywhere else in wherever your customers are, being there locally is very important to, kind of have to start feeling their cultural values naturally in you. That has a very high chances that you will do a better storytelling job because you are telling the story in their words, in their way, right? And then your audience is in the center of it, which is what people call customer centricity, and which is the reason why people say that, be co-located to your customers, meet them more often, right? Yeah. So all these things kind of enable that on the storytelling part. I also feel that a lot of times we, while Americans can be great at storytelling in America. This culture also is now kind of immune to too much of storytelling, right? So when you actually come as a more humble person with more product value, it is largely now, it is still there is difference, but it is largely equally valued in customers' mind, right? Because they are there to also seriously, to buy something serious and not to buy a whole lot crazy large vision, right? Because people have bought enough software. People know how software work, how softwares are built, how they are sold when they don't work, right? So that experience is there. And on the second side, which was the, what was the other one? Storytelling and?
To understand relationship.
The relationship. I think relationship, that's a very simple one, which is very tough one to execute, very cliche, but give more than take, right? Like if you can truly, if you like somehow build that liberty in your resources, in yourself, like maybe a patience or more money in the bank helps you develop that patience or confidence, do that. But unless you don't start kind of, giving, which means, and then giving also means truly be able to gauge the customer and if required, doing the right free pilots at the right time, right? Like usually free pilots are frowned upon in SaaS. But doesn't mean that we don't give absolute no free trial, right? We would, to some customers, we would still open up the gateway and let them try it when we know genuinely that, they are trusting us, but they just need that good touch and feel for a few days, right? And we would actually go double down on that.